Hello, everybody, and welcome to the Crypto Hipster Podcast. This is your host, Jamil Hassan, the Crypto Hipster, where I interview founders, entrepreneurs, executives, thought leaders, amazing people all around the world of crypto and blockchain globally. And today I have another amazing guest. He is the Chief Digital Officer at Luminary. Welcome, Gleb Kurovskiy, to the show today. Gleb, welcome.
Yeah, thanks very much, Jamil, for having me today. Great.
You're very welcome. Pleasure to have you on. So let's ask you for. I ask everybody the same question. They get amazing answers. Except one time somebody didn't answer the way I expected. But other than that, everybody has. So what is your background, and is it a logical background for what you're doing now?
Yeah, to sum up, I would say I was also having both macro and micro view on how the money and financial system works. And in general, myself, I started as a central banker. So I worked for like several years at the central bank in the monetary policy department. And then actually I was curious how the money works, where is all these financial systems. And in general, I think the most surprising thing for me was that we usually think that most of the money is created by the central bank, but in reality, actually only 10% of the money is created by the central bank, and 90% of them are created by the banks. So it's really not like a very common knowledge. If you maybe ask around, it's not very common that people know this. And for me, it was curious to see how it works, right? And then if you ask how the money is created, then it mainly comes to giving out loans. So every time you give out a loan, you have an increase in the money circulating in the economy. And so for this, I was curious, well, so all the money is kind of debt because it's like backed by loans. So are there any alternatives for loans? And then I started looking for some P2P markets. And for some P2P lending, it was popular maybe around 5 years ago. And then around 2021, I didn't really know about blockchain crypto before, but I saw, okay, there is some alternative for this, right? So how everything works. And then my first transaction was to buy with a credit card to buy some ETH and then swap it to some stable coins. And then I transfer stable coins to another wallet, and the transfer took 10 seconds. Right, so I was really, really surprised when all this happened, because all this like happened in one day. I did a bit of prior research, installed my MetaMask, then I created a wallet, lost half, I guess, on the gas fees in total because it was 2021 and gas fees were quite high at the time. And and that was very, very interesting because I saw an alternative that you can have some fast transfers, not a usual bank transfer, but a very different transfer, and the funds just move. And I think so for me, that was a moment that I started to dig into that space and did quite a lot. So even I finished my PhD recently here in Switzerland, and it was devoted to stable coins and tokenomics. So I was really going deep into the technology and try to understand how this part of tokens and economies work. And then for me, I think the very natural extension was with the Luminary. So where actually we do both, we do a bit of fiat and we do crypto together. And for me, it was a very, I mean, I'm both of these stages are very natural for me. And I came like from, I would say from evolution rather than from just speculation, because I'm still kind of didn't much do with Bitcoin. I started directly with Ethereum, so I didn't have this stage of Bitcoin and buying it. And now at Luminary, I'm uh, starting now. Started like less than a year ago, and we are exactly building something on the verge of the two.
Very interesting. I want to go back to the first thing you said. 90% of the money is made by the banks and only 10% by the central bank. So if I think of the Federal Reserve, I think of that as a central bank, right? You know, or am I looking at what banks what currencies do the central banks create versus what currencies do the regular banks create?
Yeah, actually, if you think what exactly is created by the central bank, what is the definition of money, then it's just cash. So all the cash is what is created by the central bank. And then the rest is everything is created by the banks. That's kind of so there is no kind right now. Before we go into the topic of CBDC, which will be something again created by the central bank, but right now all cash is by central bank and all the rest is by the banks.
Interesting. Interesting. So all the financial products, all the short-term financial instruments and got it. Okay, that makes sense. So Luminary Bank, what is it all about? What's your role? What's your vision and expertise?
Yeah, I think the vision is very simple. So we try to build finance without borders for international businesses. And I think we're quite uniquely positioned in a sense that we started a bit more than a year ago as the company. And at the beginning, the vision was, okay, we know there were quite a few developments in the traditional space. I mean, it was hundreds of years of developments. And there was already a good knowledge what have been developed in the crypto space over, let's say, starting from 2018 and really use of 17, really use of Ethereum. So you kind of know what blockchain is capable of. And then at this stage, we're a bit of agnostic about what technology use. And we just questioned ourselves, what would be the best for businesses, the most convenient way to make international transfers and to actually use both means of payments. And the idea was just to give them that. So I think there is a lot of developments for the retail customers, much less for just for the businesses. So we just entered with the business and tried to think, okay, what should we build? And then the idea was to put the crypto and the fiat team on the common footing. So there is no one that is stronger than another, or that one is dominates than another, which I think is always the case. There are different edges, and that's how we started. And so for our like business clients, we have fiat trails where you have SEPA payments, SWIFT payments, and we have crypto where we integrated through the stablecoins to Ethereum, Tron, Solana blockchains. And through us, you can also do on a ramp. And then for the business purpose, you have some perks like you can have cards, or you can have some perks from the crypto side where you can maybe more easy invest into some tokenized assets or give some crypto back loans. So the idea was exactly just to put all together and just be agnostic, just to see what people want to use, what businesses want to use. Because if you look at the international businesses that need to trade around the world, then first of all, not all of them still has very great access to SWIFT. Then also, if you want to have both crypto and fiat, then maybe you need to onboard with one bank, with another crypto exchange. Every onboarding will take you some time, and sometimes, I mean, we also onboard with banks, and it sometimes it takes months, right? And if you're a business customer and you know that you need to onboard with which of the counterparty for around a month, and then you need to think how you put together them, how you try to make them work with each other. You need to make sure that these banks know this exchange and that they accept funds from each other. So, and this is really for the medium businesses. I mean, this is very hard task to do. And with us, I mean, we take this hard work, and we already know that the tolerance of counterparties to each other. We balance this risk, so we know how these fiat and crypto can talk each other, which providers we need, and to try to do it in the most cost-efficient way. So I think this is kind of the idea that we wanted to build. Maybe one more thing that I would like to talk here is that we always have this balance between being centralized and decentralized. And there are also like extremes here. So one of them you can think of the banks, which is extreme kind of a centralization, and then you can think of, yeah, I remember there was some Mist browser back in the day where it was the most decentralized browser where even UX is decentralized, but then actually it was also didn't really kick off. And the reason, I mean, it's too much decentralized, right? You don't need everything to be decentralized. You need to be some parts can be decentralized, some parts, I mean, they shouldn't be, right? And if you think for our case, so we give you, I think you should have the right to be like self-custody and decentralized. But at the same time, if you want to have some payments with cards, which is usually not, cards shouldn't be decentralized, right? It's small amounts, small risk, you put not that big amounts there. It is fast, the settlement is fast, so you should have some centralization here. So we see that you need to balance this centralization, decentralization debate, right? So you should give the right of the customers to be decentralized, to be self-custody, but at the same time, you should give them kind of the best services for centralized opportunities, like payments with cards. They should be fast, and you don't need to put them on the blockchain so that for every transaction is hashed on the public blockchain for like, I don't know, 20, 30, $100 payments. I mean, this doesn't worth it. You can do it in centralized way. So this is kind of our vision and how we move there.
That is very interesting. I think, if I look at what's going on at the between the banks today, like JP Morgan and Fidelity and different banks here in the US, I see them, people say they have captured Bitcoin. People say the institutions have taken over Bitcoin now. But then you have, the Bitcoin decentralized influencers who are still favoring Bitcoin and the decentralization of it, yet the big banks have taken over. So you have the centralization versus decentralization battle right now. And then the decentralized folks are also arguing people should not be selling Bitcoin and going into like Zcash or Monero or whatever, Dash, like whatever. But so where's a balance? We should be clashing, right? Or we were about to clash, right? How do you come to an understanding? How do you come to a middle ground? Where should people, take sides, or what's the path?
Yeah, that's, I mean, the first thing I would say that you need to start with giving a choice, right? So you should have a choice where you want to be custodied by someone, or you want to be like self-custodied fully. So I think the first you start with this choice, right? And then if you think of the assets themselves, right, like the concentration risk and everything, I mean, there have been a lot of debates of Bitcoin and Ethereum in this regard. Like there was for Ethereum, you had these also like staking where for some time everyone was afraid that Light will take most of the share. Then you try to limit how much is the maximum staking amount by the staking provider. With the Bitcoin now, it's afraid that everything will be with the big banks holding there into custody and putting ETFs on top of that, so that actually decentralization will be much less, right? So there is, I think, and this risk, of course, takes place, right? So there is a concentration of assets. It's just that there is kind of hope here that these assets are already big enough to be fully controlled uh, by by big banks, right? So if you look at some new ones like Zcash, right? Zcash is already a bit harder in my view because I mean it's small and already banks know the game, so they can already acquire like most of the assets at much lower prices. So there is always risk of concentration. We know that the wealth concentrates, we know that assets concentrates, just that we hope that Bitcoin and ETH, for example, already at the stage that they're already well centralized around the world. Like there are country level participants, there are banks for different countries participants, there are mining services from different countries. So you expect that, okay, it's already scaled. Like you already don't really afraid of maybe a concentration of gold, right? So you think that, okay, gold is already has the market, it's already decentralized enough in a sense in terms of ownership, and so you expect that these big assets they can still like sustain for a while. And but the question would be now for some small assets that it's, I think, much more difficult for now to grow into big assets. So this gap for me is either already closed, very close to, I mean, to be close. So because for new assets, you already know the game. It's much harder to grow into big asset.
That makes sense. Starting with the choice of this. Yeah, that I like that. That makes sense to me. So thank you. I have to figure out what my choice is going to be. But I do want to know, shifting gears a little bit, I want to find out from the banking side, what's the most challenging part about, integrating blockchain, and Web3 into the existing Web2 infrastructures or architectures? How do you, what's the challenges you guys still face as banks?
Yeah, I think maybe a few years ago, the biggest challenge was just the knowledge gap, right? So you didn't know really the technology, you didn't know the regulation, you didn't know the market participants, the market, how it behaves. So, but I think, of course, banks, they usually have more resources, right? And this gap is closing right now. So I think the knowledge gap is getting closer. So I mean, there is not that much knowledge gap remaining, right? So this one thing. Another one is that the banks, they always want to have something standardized. And it is, if you look at the stablecoin space, then we have more than 300 different stablecoins. And all of them are slightly different with slightly different smart contracts. And then it's for the bank, the ideal case would be the following. The regulator says, okay, this is the contract standard that we want to have a stablecoins for. And okay, this is the smart contract that each of you should use. And then each bank participant will mint exactly the same stable coins. They will not have some liquidity fragmentation around them, and they will know how to work it. They know that it's regulatory approved, and then all of them will come up to the game and start working with stable coins. But I think the way right now it is happening slightly different way, but that's what we also see, right? So what we see is that USDC is working in this direction. So USDC started as a regulatory compliant like stablecoin, both approved in the US and in the Europe. And the way they worked is that they have programs with the fintech and payments, and they were also kind of in discussions with them. So the way how you can try to participate in the stablecoin minting process, right? So they have some requirements. It includes license capital and turnover requirements, how you can be one of the minters of the stablecoin. And then actually it's kind of a standard, right? So if everyone will be starting minting the USDC stablecoin, then like all the banks, they will have the same standard. All of them is minting USDC, and you know that it's already regulatory approved. So I think this is the path how you try to onboard different banks and fintechs and like financial participants, financial market participants who can actually work with that and be the minters of stablecoins. And this is the way how I think the current standardization issue is solved. But it's for US dollar, right? So if you think of other stable coins, then there is still a way to find out how it should be. Because we have a back office in Zurich in Switzerland, and we saw that a few years back ago there were like several different Swiss franc stable coins, but then the regulator really became a bit harder in the sense that there were high requirements. So they started requiring like full banking license to become a stablecoin issuer in Switzerland, and then many stable coins needed to stop their projects and actually redeem all the stable coins. And now it's again a new iteration on the way how you should look at this meeting process. And I think now it's they're trying to figure out what to do next, because there are some attempts that you want to standardize it and make not 10 300 different stable coins, maybe actually have one or two. But I think this is kind of the main challenges you face. So you face knowledge gap, which includes regulatory compliance, know how to do email screening of on the blockchain, and the second one was just the way how you should some liquidity fragmentation and to join at the right time with a regulatory approved methodology.
Yeah. Okay. I can get that. You said something early on about your background. You said you got a PhD in stablecoins and tokenization. I'm in the US. There's no top university that has a PhD in that. You know, so I'm glad you got it. But say you don't have the standardization. Say you end up with fragmentation. Across the stablecoin industry. Are they aren't they going to? Would that provide risks to the market? And then in those cases of risks, wouldn't also CBDCs then come into play as additional risks?
Yeah, I mean, yeah, regarding the background, I mean, it was tricky. I was part of the finance department, and then I was just convincing the supervisors that topics these are financial relevant and that they're interested enough. So, and then actually you can write on this topic. So, I mean, academia is a kind of free in thoughts, right? So usually it's the purpose of academia, so you can have research interest, but we still have some boundaries in terms of the methodology. So if you play around methodologies, but to a different topic, it's fine usually, right? But going back to the stable coins, so yeah, I think it's interesting. So the way that we at Luminary view this is that we see that the stable coins will evolve slightly. So now the main question is, so the current trend is whether stable coins can pay yield and how you achieve that. So in general, there are three main things that you should think of stablecoin. First, stablecoin should be fast at execution, but this is given because they're on the blockchain, so usually they're quite fast. So they are faster than usual bank transfers. Second one, if they can pay yield, and if this yield can be higher than, I'd say, treasuries yield or just the deposit yield is kind of the second question. And the third one, which is, I think, also very important, is the insurance. So how high you can insure your stablecoin deposits? Because we know if FDIC insurance is 250K, right? And the reason is that low. I will say it's that low because it includes market risk and bank run risks. So there is some risk that the bank can fail, and so it's very hard to insure the market risk. And usually insurance companies that don't like to insure market risk. But what you do like to insure is some technology risk. And if you put stable coins that actually they don't have market risk, like they're backed by the government bonds, or even going further, they're backed by the reserves and the central bank, then there is very low market risk. So actually you can make insurance even $10 million, right? Because it will be just a technological risk. Regarding the yield, I mean, usually the main idea with the stable coins is that you can, through the because there is a lot of interoperability, right? And you can also try to lend stable coins and also get some yield on stable coins. So there is some sources of yield that can actually cut several intermediaries, and at the end of the day, you'll get, let's say, 2 or 3% higher yield right now than the yield coming from the treasuries. So you can get a bit high yield, which still will be quite secure, apart from bearing the technological risk that you can insure. And if you can insure the technological risk plus high yield plus faster payments, then it's just a superior tool of using your funds. So I guess this is kind of a good way of thinking of stablecoins and the good thing of thinking how they can develop. And we at Luminar, we develop them in this direction. But there are also a bit of like the evil side, right? There are many discussions of tether reserves, and when you are stablecoin issuer, and when you have hundreds of billions in reserves, then there are really a lot of incentives to start investing part of this money. And if we start investing this money, then of course we start to bring risk to the system. And this is how banking appeared, right? So at the end of the day, you don't, the reason why you want to invest is that okay, at any moment of time, there will be not more than 10% of the market participants who will try to redeem my funds to the stable coins. So I will always be able to sell part of my assets and to give them these funds back, right? So there is really a lot of incentives, and this is how banking, like fractional reserve banking, appeared. So you appeared that just because you have this capacity to invest, and that people will not come to you, have really a lot of incentives to invest this. And this part that we should be afraid of. So, I mean, if all the banks become the issues of the stable coins, then it will happen by default, right? So because they know that they will be the issues and they will for sure invest them because they legally can invest this money. I mean, for example, Circle or stablecoin issues or some MiCA compliant stablecoins, for now they can't invest really their assets, and they should be like in reserves or short-term government bonds. So there is these trade-offs. So the more the banks participate in the stablecoin issues, the more actually you kind of risk inherent into the blockchain system, and the risk that the stablecoins can go to DPEX. So I'll put it be brought into so there is a very good development so that you can create a superior money, but at the same time there are risks that you just go into a direction that all the money are issued, just that they will be issued on the blockchain, but they will inherit all the type of risks that we have in general financial system.
You made me you gave me the opportunity to put my insurance hat back on. I used to work in insurance, and I was at AIG for a number of years. I left there in 2017, but I'm thinking it would be kind of good if they have an insurance wrapper on a stable coin, right? You said, and you said earlier, 300, there's 300 different, 300 different kind of stable coins right now. So I'm wondering if according to the Genius Act here in the U.S., a company like Google or Amazon would be able to issue a stable coin. And I know how they like to play around with algorithms. So would algorithmic stable coins ever work? Would a popular way to have them work be put an insurance wrapper on them, and then how would that boost the insurance industry again?
Yeah, I see your point. Yeah, it's true that you have these. So I think for now the insurance it's not maybe 100% targeting the just the stable coins. It just target in general the smart contract risk. I think there are already tools where you can insure the smart contract risk, right? So regarding the algorithmic stablecoins, yeah, I think I had the one small article like describing it. So in general, if you think of stablecoins, you think of trilemma, stablecoin trilemma, which includes that they have to be decentralized, maintain the peg well, or they should be kept. And the third angle is the capital efficiency. And you can also actually think of human beings or just in general like animals, right? So you should be able to have a choice between running, swimming, and flying, right? And if you think there are not that not that many creatures who can do perfectly all three of them, right? Maybe there are ducks who can do all three of them. But for example, we humans, we can't really fly, right? Except without using the technology. So it's the same thing for the stable coins in general. And we have algorithmic stable coins that, well, for example, we have DAI, LUSD. So these stable coins, they have proven to work well. So they have the peg, they're decentralized enough, but they're not capital efficient. So again, if you think that if you back your $100 by $150, then it's not super capital efficient. And there are a lot of incentives again as for the banks. If you're a bank, you want to back your $10 with like your $100 with $10. You don't want to be backing it with $150. So I think it's beautiful that right now we have these developments. And the reason why I have that many stable coins is that they try to solve this puzzle, and they try to find the right balance, right? And I think that just that people will again have a choice. So you can have a choice to have a stable coin that will not will unlikely to depeg, but they have limits how scalable they can be. So we can't scale right now algorithmic stablecoins to more than 200 billion, because then the backend assets of Ethereum and Bitcoin of Ethereum is like only 350, right? So if you back all your stablecoins by some asset, the asset should be big in price. And so you have limits to that. So with stable coins, with the centralized stable coins, you can tomorrow go to trillions and will be fine. So you'll not have any scalable issues. So I think this is kind of how this trade-off works. And that's why we have some attempts to build some better algorithmic stablecoins, which some of them proven to work, some of them proven not to work. But you should think of this trade-off. So if you want to be very packed and decentralized stablecoin, will not be capital efficient. So if too many people demand this, it will be hard to maintain this demand unless you tokenize all assets and then back all of them. So I mean, maybe it happens in the future, but still 5, 10 years from. But
Yeah.
what the rest? That's why I have dominance of the centralized stable coins, because it's easier to maintain back, it's easier to be capital efficient, but you're not decentralized, but you can scale faster. And scaling fast is very, very important.
Yeah. We both seen what doesn't work. So
Yes. Yeah, we see. It was
yeah,
very unfortunate.
yeah.
Right.
Well, you said run. You said fly, run, and swim, and I guess I could get on a plane, but I just had knee surgery recently, so I'm not running right now, and I got caught in a rip current in August, so I can't swim either. So I know that's not good for me. But
Yeah.
I did want to touch on one more thing. I think right now, right, we're at a fork in the road as far as banking for Web3 with regard to adoption, full embracing versus disaggregation, right? What's the long term outlook at that fork?
Good point. Good point. So I think that we definitely see much more integration between the two fields, especially last 2 years. I mean, the regulatory everywhere became better, and so banks and big institutions now have much clearer games. And then now it's actually the question what path they will choose to do. So now they have all the opportunities to integrate it. And then it's a question like whether they will do it or not, right? So once you have it, but then it's a question what you do. So I think that one development that I will see that you can really have better payment rails in general. So you have the question here is there will be only permissionless or some permission blockchains. I believe there will be some both for a while. And then you also find the ways to pay higher yield and have more secure payments. So I think this will happen. And in general, right now, I don't see that it will be overtaken by CBDCs or this central bank currency. So I think as far as I see it right now, that stable coins, if you are already kind of compliant, right, and you don't need really a central bank to intervene there. Usually central banks don't really want to intervene into the financial system because it's the role of the banks. Because then imagine that the central banks needs to KYC all the clients. How this can happen, right? This role should be of the banks. And the banks, they can just agree on one standard or take the USDC and just mean stable coins and the KYC all their clients, and they will be compliant. So there is no really need for the central bank to enter this space and just to start be an active market participant. They should, of course, do the regulatory work and oversee that they know the standards of compliance. So I see that stable coins kind of is a big. They will still have a presence for a while, and just the question how it will be mixed between permissionless chains. Because even we have maybe some lower on-chain activity last 2, 3, 4 years, but at the same time we have much faster growing stablecoins adoption. It's one thing. Another point I think you see is the development of real-world assets. And this what we also at Luminary integrate, because this is a very clear setup, right? So you have BlackRock that launched Beetle token. You have Franklin Templeton that launched a Benji token. These tokens are tokenized government money market funds. So you can directly get for now a bit less, 3.5%, and December a bit, maybe even less in the middle. So you can get yield already on top of that. And then you can build an extra layer of staking on top of these tokenized money market funds. And so this allows, for example, us to give high yield of around 7-8% to clients by combining the staking plus these money market funds. So you have a clear path how using these tools you can have high yield. And on top of these tokens for payments, so you can use this Beetle token. It's kind of NAV of one, so it's usually as same as the dollar. So you can even imagine that you start paying with some of these assets, like tokenized money market funds, because it's really new assets, and then actually you can also make it. You see the efficiency directly there, because you start paying with services you couldn't pay, and on top of that you get high yield. So usually it's just a question of arbitrage right now, that you faster entering this space, so you're already there and you can offer these high services, but it's like a very clean and superior product. That's what we see.
My ears perked up when you said high yield. I like that concept. So
Yeah.
I want to thank you very much for your time today. I enjoyed speaking with you. This is fun. And I think you're the first person who made stablecoins interesting for me. So thank you. And I have one last question. How can people find out more information about you, about Luminary? How can they become clients? How can they do that?
Yeah, I think first you should go to our website. It's luminarybank.com. And also you can follow me on social networks, both on X and LinkedIn. So we post regularly. And soon we'll have some interesting developments regarding how to do the ICO in the proper way as well. So
Awesome. And we'll talk about that. We probably talk about that in a half a year from now, you and me.
sure.
So thank you very much. Thank you very much for your time today.
Thank you, Jamil. Have a great day. Bye bye.